start now.
Good morning, all. Good morning. It's a beautiful day. It's a shame we're inside, but I hope it'll be worth it. Welcome to you all. I do this with a double hat. On behalf of Morgan Stanley, we're very pleased to have you here. And on behalf of the Bretton Woods Committee, we're also very pleased to have you here. This is one of the first times in many, many years when the Bretton Woods Committee has met in New York. We've had many of these meetings in Washington, but this we thought would be a good idea to come up here to the provinces and to see what we're all thinking about here. For those of you who are members, you know a lot about the committee and what its work is. It's been in operation, well, about 50 years or so. And its role is very important, focusing on the World Bank, the IMF, World Trade Organization, and all the related issues that go with them. And for those of you who are not members, we would be very delighted if you would join us in this effort. It's a very, I think it's a very useful and productive role that the committee plays. There are very few other organizations that really focus, not only support the Bretton Woods institutions, but are critical partners as well. And there is close relationship between the committee itself and those officials of the bank and the fund. And let's see, I would like to introduce our director, Randy Rogers, who's here with us. Our deputy director, Carmen, there you are, over there, Carmen Matsera, and Nancy Nixon of Morgan Stanley. If you have any questions, comments, or whatever, we, all of us here, as well as they, would be happy to go over them with you. Today we're going to have a good program beginning now and ending at 11 o'clock. What we will do is to have our speakers speak and then an open discussion, which we will look forward to your participation, which I'm sure will be very active. I certainly hope so. And as our, how shall I describe this fellow next to me? There's no one in the room who doesn't know Mr. James Wolfenson, I'm sure. No one who's interested in this subject. So I won't go to great length to embarrass him with a long introduction, except to say that his not only his tenure at the World Bank, but his career in general in public service and the private sector has been extraordinary. He's made significant contribution, and he is the co-chair of the Bretton Woods Committee, and plays a very important role there. And with that, Jim, if I embarrassed you, I hope I did. It's yours. Thank you.
Well, thank you, Dick. Sorry that you did the shortened version of the introduction, but I understand that. I was hoping that you might take a little time to reintroduce me to the community here. But, they're very competitive at Morgan Stanley. It's really a sad thing. I have very little to do except to get out of the way and to introduce our three speakers. We're very fortunate to have them, and we have, to start our discussion, the Vice President for Financial Intermediation at the Federal Reserve Bank of New York, Linda Goldberg. You have the resume of Linda. I won't repeat it now other than to say she is a star figure, and we're thrilled to have you here, Linda. So if I may introduce you and get this started.
Okay, so thank you for having me here this morning. I'm going to start off the discussion today by giving you an overview of some of the international roles of the dollar and how these have evolved over time, and then I'll give you some of the traditional international roles of currencies. I'll also ask the question about whether we care at the end of my remarks on some of these comments, or what are the consequences. And I'll say a little bit about a particular role of the dollar in international banking and how that's evolved. But again, I'm just going to be teeing off some of this for the broader discussion of the panel and then amongst us all towards the end. So if you thought about the traditional roles of currencies, international roles of currencies, and by the way, let me step back and say that often there's a little bit of confusion between roles of currencies and values of currencies. So I'm not going to speak at all about the value of the dollar vis-a-vis other currencies. It's only about the use of the dollar in a range of contexts. So the traditional roles of currencies are their use as a store of value, medium of exchange. Do they serve as anchor currencies in exchange rate regimes internationally? Is a currency playing a primary role as a vehicle of national savings in their foreign currency reserves? If you look at currencies used for transaction purposes, is a currency a dominant transaction in foreign exchange, in international capital market transactions? And also, importantly, is this currency used and accepted across countries in the invoicing and settlement of international trade transactions? So this is the general traditional scope for discussion. Often you hear, I think, more about the role in official foreign exchange reserves. I'm not even sure that's the most important role. I would almost argue it's not, but I'll just show you where the dollar is in each of these. A less traditional role, and one that's been much more in the spotlight in the last decade, have been the use of dollars in international banking transactions, and in particular, gross flows in dollars have soared over the last decade, with the dollar being used as a strong funding currency in global banking. So just a number of slides, again, just to tee up our discussion. First, that the dollar remains a central currency in the exchange rate regimes of other countries. This is a chart that shows how many of a group of 207 countries on which we have this information, how many countries have their currencies tied to the dollar. And in terms of tied to the dollar, it's that their own currencies are dollarized, or there's a currency board, there's a peg against the dollar, or managed float against the U.S. dollar. And the chart shows the numbers in each of these categories in 1995, 2000, 2005, and 2010. And you could see from these entries here that the share of countries that remain linked to the dollar has been remarkably stable over really the last 20 years or so, and even going further back. I don't have this in the table. And there is even an increasing share of world GDP that's linked to the dollar, although that's primarily due to the growth of China. What about the dollar as a reserve currency? This is the thing we hear a lot about. So this is a picture of the evolution of foreign exchange reserves of countries since the late 1990s. And all you see in this picture are volumes of international reserve holdings. And you could see that the blue block there represents developing country reserves, the red industrialized country reserves. And you could see, first of all, that international reserve holdings are in the range of $10 trillion right now. So that's a kind of hefty chunk of change out there in terms of country savings, official savings. And the bulk of the growth over recent decades has been in developing country reserves. Now, if we look at the composition of these reserve balances over time, we find that the dollar still has a dominant role despite some recent decline in developing countries. So what are you looking at? You're looking at 3 blocks of bars. The first block that is all the way on your left represents the share of the dollar in industrialized country reserve portfolios. Within that block, you have one bar that shows 1999, the next one 2003, the next one 2007, and then the most recent data, which is from Q3 2011. And you could see among industrialized countries, there's almost no change at all over time in the international role of the dollar in their reserve movements, their reserve portfolios. Now, across developing countries, there has been some decline in the role of the dollar over time, but the dollar still stays above 60% of the portfolios of developing countries. And in terms of the total, really there's still quite a lot of stability, and it's a degree of stability that is even magnified under some exchange rate configurations, but generally it's very stable over the last decade. So this has not been a role of the dollar that has eroded. When the euro came on the scene, the euro largely replaced the legacy currencies of Europe in the portfolios of reserves across countries, and some of the particular growth that occurred in the role of the euro over time occurred through 2004. Then the euro's role flattened out, but most of the growth of the euro occurred at the expense of the Japanese yen, as opposed to at the expense of the U.S. dollar. What about in foreign exchange markets and foreign exchange transactions? So the BIS does a survey every 3 years of the amount of foreign exchange transactions that take place and various features of those transactions, including what currencies are used there. And here you have the breakdown of the composition of currencies in foreign exchange turnover, again, starting in 1995 and going through the most recent survey, which is 2010. Now, these are shares of transactions in foreign exchange markets, and you might be puzzled that these shares add up to a number bigger than 100. And that's because every transaction in foreign exchange markets involves 2 currencies. So, of course, these would add up across all currencies to 200%. But you see that the dollar accounts for fully 85% of transactions in foreign exchange markets. And while there's been a little bit of a dip of this over time, really, again, the dollar's role has not altered materially over time. And again, there is some uptick over time, you could see in the euro's role, and some change over time in emerging market countries, and I know a little of that will be discussed by the other speakers. What about in other types of international transactions? Well, one theme is how is the dollar used as a currency of financing in international capital markets? So one place to look is international debt securities. And the European Central Bank, every 12 to 18 months, puts out a very nice report called The International Role of the Euro. And they have some calculations about each currency's role in, for example, debt securities, bond issuance worldwide. And if you look at the blue line, that is the share of U.S. dollars in all debt securities issued anywhere in the world. And you could see that from 1999 through the present, that's hovered around 40%. It's dipped a little bit over time, just down to about 30%, as some of the euro area countries have deepened bond issuance within the euro area. So, but still 40% role in all debt securities. If you look only at the part of borrowing that's done in international markets, so that is outside, when you look to raise funding outside your own jurisdiction, The dollar is nearly 50% of all international borrowing, all borrowing that's done in this international way as you reach different investor pools. And that share of dollars has actually risen considerably over time, even with the Great Recession in the United States. So what about explicitly in global banking? Now, dollars and the role of the dollar has been a very prominent feature of recent crises. And you know that the shortage of dollars, for example, in euro area countries, especially banks, started to be noted in the mid-1970s, and there were escalating stresses in funding markets, and ultimately we had a series of central bank swap agreements that were put in place and so forth. So dollars have been a prominent feature of recent crises. This is a very hard picture to look at, but I'm just going to say a couple of words about it. The BIS tracks data on international bank flows. So for any bank, what are their positions vis-a-vis counterparties in the rest of the world? And then they approximate what are the currencies used on different international transactions. So what they report on, and this is from a BIS report, number 291, I don't think I put it on the slide, unfortunately, is they look at, by country, the net dollar positions of that country's banks vis-a-vis different counterparties worldwide. So, for example, if you look at the positive values in this chart, those are when one country's banks are in a net asset position relative to counterparties worldwide, and the negative numbers are when that country's banks are in a liability position vis-a-vis different counterparties worldwide. And I just showed you here UK banks, Japanese banks, and German banks. So what do I want you to take away from this picture? First, these are net asset or net liability positions with different counterparties. And if you look, for example, at the central picture, which is for Japanese banks, one first observation is the incredible growth of these net positions even over the last decade. So these net positions have grown tremendously, and underlying those net positions are large gross positions that have grown even more. Okay, so that's the first thing. The green lines are the net banking sector, and this is all, by the way, in dollars. So these are, for any of the banks in these countries, their positions in dollars vis-a-vis other counterparties. And what you can see by these shaded areas are, which all are in the net liability position, is the much more extensive, the yellow tan block, the much more extensive use of cross-currency positions, swap markets. What you can see by the green line is the role of non-bank counterparties. We talk about often the shadow banking system, hedge fund, and so forth, and how that's risen over time. If you look at the UK and Germany, and also for Japan, for the UK and Germany, how some of those counterparty positions have dropped off over time. So this is another very active area for the role of the dollar internationally, which is as in these kind of funding markets and net imbalances of banking systems. Now, when we look at the dollar's role in recent crises, though, I'm showing you dollar positions, but is this the dollar role per se? That's a real question. Or alternatively, this can be just an issue about a global banking model, which is that some banks raise wholesale funding in the U.S., for example, and they ship those dollars back to their head offices, and then the head offices are in charge of reallocating these dollars to whatever investment locations take place. So, these escalate gross flows, but it's not clear that this is about the dollar's role per se. These gross international capital flows, they have very positive effects, but they also do raise some concerns. Some have pointed out how they exacerbate vulnerabilities for financial systems. They pose challenges for lender of last resort functions of the central banking community and challenges for regulators. They challenge liquidity provision, especially if a central bank is asked to provide liquidity in a foreign currency. And we've seen that the central bank dollar swap facilities have been proved important in this context, but there are a range of questions that still remain on these roles of the dollars in this context and these types of funding models. What could be the effects of reduced dollar roles? And this will be my last slide before turning it over to my colleagues. You hear things like seigniorage, which are the revenues you get when other countries basically hold your currency internationally. The U.S. has about $1 trillion of cash in circulation. The estimates are that something upwards of 60%, for example, of $100 bills are held outside of the United States. So that is a lot of dollars held outside of the United States, but we're also in a low inflation environment. So seigniorage revenues in the scheme of things aren't the first order concern. If the dollar were used less, you can have higher funding costs in the U.S. The dollar value could potentially depreciate from a reduced role of the dollar, but even that's not entirely clear. One thing that I think is particularly interesting is how the dollar's role interacts with U.S. being more insulated from foreign shocks, from other shocks around the world than it otherwise would be, and other countries being more prone susceptible to events that happen in the United States. There are potential fiscal consequences if the U.S. faces higher funding costs in particular. And, of course, currency roles are sometimes viewed as going hand in hand with global influence. And if there were to be a significant decline in the dollar, that might also go along with a reduction in U.S. global influence. So let me leave it at that and turn this over to our next colleague.
Thank you very much. And for our next colleague, we have Mansoor Dailami, who is manager of the Emerging Global Trends team at the World Bank. And he is going to take on the issues of what might happen as we challenge the dollar or we move from the dollar. Mansoor,
thank you. Well, thank you very much, Jim. Let me say it's a great pleasure and honor for me to be here and be part of this distinguished panel. Linda focused on the future of the dollar, and I will talk about the future international monetary system. And whenever we want to look into the future, I'm reminded of the quote by the preacher of the Kansas City Royals, Mr. Dan Queensbury. He's quoted to say, "I've seen the future. It's much like the present, only longer." I think when it comes to the future international monetary system, let's hope that the future is better than present and definitely than the past. Let me then focus on what are the, I think that's Linda's. Can I make the, sorry. This is Linda. Sorry. This is the next one, yeah. Can we put from there?
Yeah, it's probably from
I don't know if there's an escape here.
Yeah, that's it. That's it. Thank you. Well, I guess the fundamental question that we need to ask us, how the international monetary system is going to respond in how we see the whole global economy is going through a significant transformation. Basically, the balance of global growth, investment, production is shifting from advanced countries to emerging and developing countries. There are different ways that is being described. Some people call it the grand convergence. We call it the multipolarity, that as you look into the future, you're going to see a multiplicity of global growth, many of these from developing countries. Therefore, how the rise of China, how the rise of BRICS, how the rise of the so-called the rest is going to change the whole structure and architecture of the international monetary system. The scenario that we are proposing is basically, if you look in the next decade, by 2025 or so, you're going to most likely see a kind of multi-currency regime that the international monetary system, from the exchange rate arrangement, the currency aspects, will be dominated by three currencies: the US dollars, the euro, and the Chinese currency, renminbi. I know you're going to be surprised about the second two, but bear with me in a minute. But as we look into the future of international monetary system, I think another issue that we need to look at is how the voice and the participation of developing countries this time could be much better incorporating the design of the architecture that at least in 1945 to a large extent they were left out. They were mostly like treated as a periphery. And when you look at this one, the principle that we look at is the legitimacy of the system. To what extent the voice of developing countries are accommodated. We want the international monetary system, which is especially is the instrument to advancing growth and investment. But by itself, it should be an instrumental. We need to make sure the international monetary system that fosters greater stability and sustainability in global finance, in particular capital flows. As Linda mentioned, as we have been experiencing in many developing countries, is this volatility in capital flows that's creating major policy challenges for many developing countries and even emerging market countries. Then let me start with the first issue. If you look at the next, let's say, decade or so, we predict that China, in terms of economic size, the GDP, would most likely overtake the United States by sometime 2024. It's most likely that India would even surpass Japan and the United Kingdom. We expect by 2025 the 6 emerging market economies, Brazil, China, India, Indonesia, South Korea, and Russia, would account almost for 1/2 of the global growth. And that is really what we call the multipolar order. And the shift is not just in the growth part. When you look at even the changes in the trade pattern, the direction of trade, this has been going on for the past couple of years. We see more trade between developing countries themselves, what we call the South-South trade. For instance, if you look at the China, we now today, there are almost 60 countries, virtually in most regions of the world, that they have China as the number 1 or number 2 largest trading partners. And these countries not just in Asia, in Africa, in Latin America. If you compare that to the United States, it's roughly 50%. Therefore, China has been able to establish much more stronger trade linkages with more countries than even to the United States. But focusing on the international monetary system, because I'm going to look in the future, is always nice to look at the back. If you go back to, let's say, 1860s and 1940s, the British pound obviously was the dominant currency. The dollar took over sometime around the 1920s. In 1930s, we had 3 currencies: the dollar, the British pound, and French franc. In the 80s, we had more or less 3 currencies as the major principal currency: the dollar, the Deutsche Mark, the yen. And looking forward by 2025 so much, as I said, most likely you have those 3 currencies. Now, let me focus first on the problem that the euro today is facing and why we expect that the euro most likely would survive and continue to be an important currency. The number one issue is that, as I think Linda even highlighted, when you look at the euro as a currency, as an international currency, it has performed relatively well. From its birth in 1999 to today, in terms of both when you look at the reserve currency, you can see the share of euro, in fact, has increased. Today, about 26%. When you look at the euro reserve as a transaction currency, international global exchange market, it has today increased quite today, and about 29% today. I mean, then you have to distinguish the euro as the current international currency and euro as a single currency in the EMU. And again, if you look at the European Union, European zone basically, the 17 member countries collectively as an entity, on the external side, they have run a relatively balanced current account surplus deficit compared to the United States has been deficit or Asian countries have been surplus. Therefore, in this debate about global imbalances, the euro area has been kind of neutral. It's really not running a significant surplus or deficit in aggregate, as we talked about. And even when you look at the aggregate debt, government debt of the euro area countries, it's been obviously much less than Japan and similar to the United States. Then the problem really has been of two kinds. We have gone through a significant market failure and institutional failure. There's been much talk about the institutional failure, that why the EMU had established a monetary union without some kind of fiscal union or economic union, but at the same time, the markets did fail some of the European countries. If you look at how much the spreads between the euro area countries narrowed quite significantly after joining the EMU. In fact, even if you look at go back to the greatest spreads by October 2009, it was about 140 basis more than German ones. It was a significant, the markets really did not detect or signal the deterioration in public finances or grades. The markets really left that out. And when they reacted in a panicky way. So basically credit ratings being downgraded significantly and bond being shared. And that's why we see significant widespread in the spreads. Now, the other side, obviously, that the problem has been significant amount of the intermediation within the euro area countries by euro area banks, and therefore the high exposure that have built up today, and therefore that's why they say the euro crisis, not just only a sovereign debt crisis, is simultaneously a banking crisis too. But then, the crisis happened in a relatively bad time. We can't say there's always a good time for having a major sovereign debt crisis, but definitely 2009 was the worst time that could happen. It's a time that the whole global economy was going through a significant downward shift. The recovery from this great recession has been very fragile, has been very protracted, and has been very difficult. Now, focusing on the renminbi, why we believe the renminbi has a chance to become an international currency in the future. Number one, as I said, it was really the growth and the dynamism that we see in China, both trade and investment. It's also the government policy. It's seen sometime around 2009, 2010, that the Chinese authority decided to promote the internationalization of renminbi. There were several statements in that effect that one can add here. And the strategy that they followed were basically three phases. Number one, promote the use of renminbi as the invoice for trade settlement. And you can see that has been going on quite significantly. Today we estimate close to 10% of the China's trade, total international trade, which is the order of $3.5 trillion, have been denominated in renminbi. And this is most likely to increase in the future. This is, I think, in phase one. Phase two has been basically trying to promote the use of renminbi in the international financial transaction by promoting a development of an offshore bond market in Hong Kong. And this is, again, since basically July 2010, that the Hong Kong banks have been allowed to issue deposits in renminbi, and various borrowers, including international financial institutions, some corporations in the United States, have been allowed to issue bonds in renminbi. This has been growing quite significantly, but it's still, in terms of size, is very small. I have to say, both on trade and the investment side. But the potential is there because there's a government policy. Having said this one, I think we have to put that in perspective. What we are talking about is still there is a significant impediment to international renminbi. Number one, renminbi as a currency is not convertible in capital account. is convertible on a current account. China's whole financial system, local capital market is significant development. China needs to liberalize capital account. China needs to move to much more floating exchange rate. But it seems these are the issues that through time may come through. I mean, I think that authorities are very conscious of that. They know these are the steps to be taken, and the markets do expect that the renminbi will be becoming a much more important currency in the future. Now, I talked about the interest and the commitment to the developing countries, and I mentioned that in the original design of Bretton Woods, they were basically kind of, had not this, let's say, active role. It was much between the United States, Western Europe, and Japan. And it's very interesting, some of us who have been more interested in the history of Bretton Woods and go back to that time, we see that even the first World Bank loan was not to a developing country, it was to France in 1947. The first loan to a developing country, to Chile, was 1948. And it was very after the Marshall Plan was launched that even the World Bank started paying attention much more to developing countries. I think Linda mentioned this one. One of the big issues for developing countries, emerging markets today, is this high volatility capital flows. How they manage that. I mean, this is just bond issues by corporate sector from emerging market economies. You can see significant volatility. Whether you look at other bond issuance by sovereign, look at the equity markets, it is this volatility, ups and downs, which is really creating a big problem for the market manager. Why? Because they put a lot of pressure on the exchange rates. During the crisis, the exchange rate was depreciated quite significantly. There was a lot of upward pressure in 2009, 2010. Recently, again, we see downward pressure on exchange rates. The good news that I want to highlight that during this crisis, compared to the previous crisis, Asian crisis in 1997, or the even Mexican crisis in 1994, the majority of developing countries today, they have a floating exchange rates. And this has been a tremendous use for them to be able to adjust to this fluctuation to exchange rates. Let me conclude my presentation with another quote. This one from President Truman. In his address to the opening session of the United Nations Conference in 1945, he said, "We must build a new world, a far better world, one in which the eternal dignity of man is respected." I'm going back to that time because this was a type of vision, type of commitment to the multilateralism, to the multilateral institution that really provided a foundation. And I think this is the type of vision that maybe, hopefully, we should be committed ourselves today. Thank you very much.
Well, thank you very much indeed. And we now have Gabriel de Kock, who is from this House, and we're very happy to have you, Gabriel.
Thank you very much. And I don't have slides. I figured that in contrast with international monetary arrangements where the first mover advantage is very important, I will rather take advantage of the last mover advantage. Why is that? For the very simple reason that I'm a currency strategist at Morgan Stanley, which means that I earn my daily bread by trying to forecast where exchange rates are going to be in a month's time, maybe 2 months' time, and maybe 3 months' time. For me to stand with my colleagues here and talk about the long-term future of the dollar and the international monetary system is downright intimidating. So I figured, what's the best way for me to do it? I think my best way is to do two things. A, to make a couple of provocative predictions, and then to disagree with my colleagues as much as possible, to thereby try to get the juices of the discussion going. And so that's the plan that I would like to do. And what I would like to make is a couple of points about the international role of the dollar and other currencies, both in terms of private sector transactions and then in terms of official transactions. And I think when observers read the history, there's often a misunderstanding of the drivers of the private sector roles of the currencies and their public sector roles. And the most important difference is that in the private sector, economies of scale and network externalities are a key component of the advantages of using a single currency. I mean, if you look at Linda's charts on the role of the dollar, I think the spectacular standout is how stable the role of the dollar has been in private transactions. And that is the very reason that if your colleagues somewhere else use a currency, you are better off using the same currency. Or another way of saying this, if people speak English, you're better off speaking English. That's a classic example. And what does this mean? In terms of the international use of currencies in private sector transactions, I think this yields a couple of very simple predictions. Number one, if you look at where the euro plays a key role today in private sector transactions, it's mainly in Europe, with obviously outside of the eurozone in that environment. If you look at the issuance of bonds, it's mainly in the UK, obviously in the eurozone, and then in Eastern Europe that are euro-denominated, for example, as Linla has pointed out in some of her papers. What does this mean? This means most likely that this regional advantage that the euro has will only grow to the extent that this region grows relative to the rest of the global economy. And everything else the same, since European policymakers apparently have taken the notion that they should have a long-term, well, I'm not going to call it a depression, but a very difficult economic adjustments, we should expect everything else the same to see the role of the euro in international private sector transactions to decline over time rather than to increase. Now, the interesting thing, or the interesting difference between the history that we have seen over the last century is the role of government policies in fostering the international use of their currencies. What we are seeing today in China, as Mansoor has pointed out so eloquently, is the first time since the creation of the Federal Reserve System in the United States and the leadership of Benjamin Strong at the New York Fed that policymakers have actually in a particular country pushed the international use of a currency. If you look after the Second World War, for example, there was an extended period in which the most rapidly growing economic regions, Japan and Europe surrounding Germany, actually had actively discouraged the international use of their currencies. And as a result of that, in terms of the long term, put them at a permanent disadvantage in international private sector transactions. What does this suggest to me? It suggests to me that since we've all come to the conclusion that we are becoming used to diminished expectations in the United States as well as in Europe, and since most of us believe that Asia is going to be the locus of economic growth in the next 10, 15 years, and China is taking as a policy priority the use of the renminbi in transactions within the region, we should expect to see the renminbi in many ways overcome the last mover disadvantage in its role as an international currency in private sector transactions. Enough of that. So bottom line is here, if you are an international banker, you want to make very sure that you look at your operations in Asia, because that's where the growth is going to be. Now, obviously, it is not necessarily the case that the growth of a financial center is solely restricted by the growth in its region or the role of its currency. I think every one of us goes to London more often than we would like to, most likely, and we know that London has played a much more important role in international finance than the UK's role by any means would suggest. Now let me step back for a moment and try to be provocative as well about the use of the renminbi, the euro, and the US dollar in public sector transactions, and particularly in international reserve holdings. And I think what is very important to note is that technology is separating to a greater extent than ever before the possibility for official institutions to separate the different roles of currencies. If you want to intervene in the foreign exchange market, let's face it, your options are driven by what are other people trading in. That you're going to be intervening in the currencies that are most liquid. Most likely, you are going, if in any managed currency system, that's going to be the case. So if that's your view, if you look within the Asian currency bloc or within Europe, or more generally, you would still expect to see that the dollar and the renminbi, I think, primarily will play the role as the intervention currencies, and most likely also the currency in which other currencies are pegged. On the other hand, because it becomes cheaper and cheaper to exchange your store of value for your transactions currency, it is increasingly likely that we will see a separation of the reserves from the intervention roles. And here I would like to be provocative, not downright outrageous. What does this imply to me? It implies to me that most likely the euro's role is going to, as an international reserve currency, is going to accelerate in the future rather than decelerate. And why is that? Because of the sovereign crisis in Europe. If you look back, and Linda's data once again becomes useful, and it's not often that I get the chance to use someone else's slides quite so extensively, but if you think back of Linda's slides, you will see that it's remarkable how constant the euro's share has been, despite the fact that if you look back at what prominent economists forecast, I believe most likely the most aggressive forecast I've seen would be that the euro would replace the dollar as the predominant reserve currency by 2015. That obviously has not happened. And most likely, why has it not happened? Because the key factors for the success of a currency as a reserve currency have not been met. What is that? A massive, deep, incredibly liquid market of domestic assets and very free transactions in and out of that market, and all the usual stuff that people mention in terms of the legal system and the rest. What have we had in Europe? We've had a fragmented bond market. If you wanted to hold your international reserves in euros, you could choose whether you wanted to hold it in Greek bonds or German bunds or BTPs or in notes. You had a choice. There was not a single integrated market. The liquidity was simply less. What is the end game in Europe today? If you agree with me that the current sovereign risk crisis only will be over when there is joint issuance of a Eurobond in Europe, what you have to assume is that we are going to look at the possibility that international reserve managers will in the future face a European bond market that is not only as big, but as liquid and as integrated as the US bond market. Let's face it, no one in the international reserve community is investing in munis anytime I've seen. So you're going to see the key constraint that has held the euro back in its role as an international reserve currency is being relaxed by, admittedly, a rather unfortunate set of events. On the other hand, despite some of the more aggressive predictions for the role of the renminbi as an international reserve currency, I have to be pessimistic. And why do I have to be pessimistic? For the simple reason that the true convertibility and the opening up of China's capital markets to the rest of the world that will be required for the renminbi to become an important reserve currency is inconsistent with China's economic model and will be inconsistent with China's economic model for a considerable period of time. And like Fed officials, I'm not going to put a date on that. Or like Fed officials until very recently, I'm not going to put a specific date on that. Why is that? As Linda had mentioned before, if your currency is used as a reserve currency, everything else the same, you are running at a higher level of valuation. That is very difficult to run an export-oriented economy or an export growth model new mercantilist, if you like we see in China today with that type of an environment. If you look back at Germany and Japan in the 60s and 70s, that was exactly the reason. Similarly, if you look at China's system of directed credit and control over the allocation of capital, you see a very analogous situation why Japan tried to keep foreign investors out of their domestic financial markets as much as possible in the 1960s and 70s. And once again, the Chinese model at this point, and for much longer than I think many of us would like to admit, will be inconsistent with that. So here's the bottom line. Euro, less important as a private sector international currency, but more important as a reserve currency. The renminbi more important as a private sector transaction currency, but most likely a negligible role for the foreseeable future as an official reserve currency. I'm not going to talk about SDRs. I think anyone who is as old as I am, and I've had as many gray hairs, and I've seen some of the politics surrounding the original creation of the SDR, is not going to go there. Thanks very much.
Well, ladies and gentlemen, we now have 35 minutes for some questions, and I think we should open it up to the audience to see if you have questions of our three speakers. If you do ask a question, could you mention your name, and there are two people on the side who will give you a microphone. Is there anyone who would like to ask a question? Here's a gentleman on the left.
Thank you. I'm Paul Applegarth. And you didn't want to talk about SDRs, but that was going to be my question, so I do want to talk about SDRs. What, in this, as you look forward, what kind of role do you see for composite units like that in the regimes that you have described?
Please.
Well, I think with the SDR, I totally agree with my colleague on the SDR. I don't see much of the future for SDR. It's, there was some excitement with SDR when the world economy goes through a financial crisis. We saw quite some discussion in 2009, and it was actually even supported by some emerging market countries, Russia, even Brazil, China for sure. They talk about that, making SDR a much more prominent reserve currency. But the problem with the SDR since its creation in 1969 is the way that the SDR has been allocated is very much politically determined. We have had three general allocations in the 1970s, in the 80s, and there was quite 162 billion SDRs in 2009. The fact that the United States has the veto over, in the IMF, in the allocation of SDR, very much means the SDR allocation as a decision by the United States, by itself. That's number one. Secondly, it's not being served as a, number one, not much of private use. It's been used more in the central banks. And when you look to the future, I think it's going to be very difficult to have a currency that provides liquidity for market. And given the size of liquidity market today, to let it by an institution to be decided through a political process. I think this is the number one. And as I said, the history shows that it usually comes up on the agenda whenever there's a major crisis, talk about it. But if the report that we have come up, we look at it as a scenario, but not a likely scenario.
That's it. Couldn't have done it better.
Yes, sir. Gentleman here.
Thanks. This is Karthik Shankaran from Cove Point. One thing that I'm reminded of is when Governor Zhou wrote his piece on the use of the SDR in 2009. It came like 2 days after QE1, as I recall. And apart from the timing, it seems to me one of the important issues is the relationship between global price stability and domestic price stability, because that's key. If you're an international issuer of fiat currency reserve asset, then what you need, in a sense, is the congruence of domestic price stability with international price stability. or alternately a choice to favor international price stability over domestic price stability, which is kind of what the UK did in 1925 when they went back on the gold standard. If you have a period of kind of asymmetric deleveraging in the developed world versus everybody else, and it's going to happen to some degree in Europe, some degree in the United States, it seems to me that contradiction just keeps getting wider because domestic monetary policy will target a consumption basket, if you will, that is subject to deflationary pressures, while the international holders of that asset are looking towards a different consumption basket in terms of what they expect that currency to be a store of value. And to me, this is the heart of why Governor Zhou wanted something different. If this persists, I mean, I'm more pessimistic about the role of the dollar over medium-term horizon precisely because of this problem. I was just curious if you could comment on that.
I'll jump in if you don't mind. I think you're absolutely right. If you look back at sterling's role in starting with the First World War and into the 1920s, in fact, the fact that the UK suspended convertibility of sterling into gold and the US maintained that convertibility was a key factor in driving the dollar's very rapid increases in the use of an international reserve currency. By implication, what this tells us is that since the key requirements for an international reserve currency is stability in addition to liquidity, I think there is a market punishment mechanism. And to be honest with you, this is the reason why one can be very pessimistic about the US dollar's role, for the simple reason that we are on an unsustainable fiscal path. We are using at this point, or it looks like we are going to use financial repression in some form or another to support government expenditures, or at least lower the long-term growth of the real value of government debt. That is inconsistent with the use of the dollar as an international reserve currency. So to the extent that you follow policies of this sort, and I think the fiscal issues are more important than the monetary policy issues, to be honest with you, what you will see is that will shift the relative growth in favor of currencies that have similar levels of market liquidity but more stable macroeconomic policy frameworks. That, by the way, if you wanted to go, if I had thought about speaking more carefully, is another reason why most likely you're going to see the euro's role increase more rapidly in the future, is because you might not see a hell of a lot of growth, but you sure as hell are going to see price stability over time in the eurozone. And as a result of that, I think you do see that there's going to be a market discipline in many ways of a shift of the balance between different currencies as reserve assets. That's essentially my answer. Does it mean that we don't want an SDR? I think ideally, if we could make the world over, and Keynes was still alive, and Mr. Williamson were more reasonable, we would have had a different system today. We don't. And it's like a Vermont farmer trying to give you road directions when he tells you if you want to go there, you don't want to start over here. And that's exactly the political situation we are in today, unfortunately.
Lillian, please.
Yeah, so I'll come to your question a little circuitously. So first, in terms of any currency's international roles, has been noted, there does end up being a lot of inertia in those roles. One key factor is the kind of inertia that comes about because of liquidity of currencies in the bond market. Asset liquidity is obviously very important for that. In terms of the roles of, but it is possible to have switching in these roles, and the switching of those roles could be policy-induced, but you'd also have to get a lot of market buy-in because first and foremost, all of those kind of roles that I spoke about, there are only some of them that the government can really be pushing on its own, through contractual invoicing and so forth, or, well, you use my currency, I'll give you foreign direct investment. There's only so far you can push that part. In terms of country-specific inflation rates, and of course, by the way, throughout all my comments, I'm speaking on my own behalf and not on behalf of the Federal Reserve Bank of New York or the Federal Reserve System. In terms of inflation trajectories, a couple of points on that. First is that these roles of currencies have, again, been remarkably stable even through periods where inflation rates around the world diverged from each other. And in part, that is because the rates of return through interest parity kind of conditions and so forth, the rates of returns on assets tend to compensate for whatever the inflation rates are. So while you do want a low inflation currency and you want a stable inflation currency first, if you have some deviations in inflation rates across regions, that still does not necessarily alter the roles of currencies. In terms of an SDR basket, I think the trade-offs have already been discussed, but in terms of your own portfolios for transactions, you could always generate your own optimal portfolio of currencies for use that best reflects your own trading and investment partners. And, it's not necessarily the case that the kind of weights that would be in an SDR basket would be optimal from any particular country or investor's standpoint.
Yes, please.
Thank you very much. Kotacha, SCIC. My question is to Mr. de Kock. You had two provocative statements, actually more, but let's stick with two. The euro, strong for official role, weak for private. I presume that is assumes that euro bonds are issued. They may not be. And so if they are not, how would you shift that projection? Second, on the renminbi, you said strong private role, weak official role, because their model, mercantilist model, requires them to have competitiveness, which would be diminished if they had an international currency role. What if their model has to change, as the world is urging them to, at least the OECD world, to move towards domestic demand-led growth rather than export-led growth? Would you change your projection?
The cards are off the table if you assume that there is no some form of fiscal union in Europe in the long run. I think that for the simple reason that I am not going to be provocative and forecast that the Eurozone won't survive. I think I agree with Mansoor on that. But I do think that for the Eurozone to get an advantage in using the euro as a reserve currency, you need a more liquid and more integrated and less fragmented bond market. So that is the answer. That is the conditional, and then the answer would be very different if not. In terms of the Chinese growth model, I think there are two components to it. There's the competitiveness component, and then there's the allocation of capital in the domestic economy. And I think, from my perspective, the currency appreciation is a tiny fraction of the problem. The much bigger issue is that we have a system that has underpriced and capital for a very, very long period of time, and that has allocated capital on the basis of a variety of criteria that might not be the same criteria that are enforced if you completely open your domestic capital markets to international investors. So the key question, I think, for me to think about the role of the renminbi as a reserve currency is not just the competitiveness, I think that's a relatively less important component, but really the allocation of capital. And that's where the costs of adjustment are. You know, people always, if I may sort of make a comment on the way we think about the world. If you look at economists over in the West, we often tend to look for a crisis to happen somewhere in China. And that's because we see fundamental misallocations and we expect the markets to correct them. And in many ways, I think once you open the Chinese financial system much more aggressively to global participation, the likelihood of those sorts of events occurring are much greater. And so, by implication, if I were a domestic policymaker there, I would like to see a much longer period of liberalization and changes in the allocation of capital domestically before I open up, because the cost of adjustment could be very severe if you went the other way.
Yes, sir. On the center and then one over here.
Andrew Yu from Deutsche Bank. China has recently entered into a number of rather substantial bilateral swaps with various countries. Most recently, I think, with the Central Bank of Argentina. Do you see this, I guess, based on Mr. de Kock's controversial comments, do you see this as purely for export-driven growth purposes and not at all with a view to an increase in China's, increase in the role of the yuan as an international reserve currency? And secondly, why, given that these bilateral arrangements would effectively I guess, drive down the value of the currency, why would this not have received more coverage in the press than it already has?
That's a tough question. I'll start by admitting that and remind me to try to be less controversial in the future. I cannot answer for the press, so I'm going to leave that aside. I do think what we are seeing is an unprecedented set of policies to foster the internationalization of the use of a currency in transactions. Why? Advantages in terms of the ability of your local market participants in hedging their exposures to international events. There are potentially significant advantages for growth in your domestic financial system if your currency becomes a more important player in global financial, private sector financial transactions. But I do want to make a clear distinction between increasing the international role of a currency and easing its use in private transactions and making the commitments or taking the consequences of essentially allowing the global economy to play football in your capital markets. I think there's a qualitative difference between those two.
You know, but these are first steps. And if you're going to get to a point where you do have enough liquidity and low liquidity in your financial transactions and low enough transaction costs in your private sector transactions, you do have to seed this by getting your currency used in whatever possible ways you can. You know, the numbers that were shown, that Mansoor showed on the growth of the renminbi in settlements, trade settlements by China, the vast majority of that growth is in still bilateral transactions with Hong Kong, not externally. And even the bond market, the financial market transactions are issuance in Hong Kong, not in the rest of the world, but it's getting experience with different kinds of transactions and, you know, I guess an ultimate goal of pushing this out. further. But there's still ways to go. There are lots of currencies around the world that are potential candidates with deeper markets and open capital regimes. And, of course, China has the advantage of being so far on a very strong growth trajectory. But there are a lot of other conditions, as was noted, that are needed for market adoption.
Let me just add one point to this. I think if you go back, many of this swap arrangement between People's Bank of China and the other central banks in Asia initially and Latin America was in 2009 and was in the depths of the financial crisis. It was more or less the same time and the U.S. Federal Reserve expanded the Fed. I personally, because we obviously were monitoring the situation, I wouldn't believe that it was because of export promotion strategy at that time. It really was the part of coordinated effort by major central banks to get the global economy out of the deep recession and out of financial crisis. Now, whether in the future it would facilitate trade between obviously China and other countries, yes. But the initial intention was much more genuine and much more as a part of coordinated efforts than any export promotion strategy. Thank you.
Is there someone over there?
Thank you. Mike Moran from Standard Chartered. I think there was a very pervasive point about how important a deep local asset market is critical to having a reserve currency. It makes intuitive sense. But is the panel surprised by the role of the declining role of the yen over the last 10, 15 years with respect to the fact that obviously they have a very deep, very broad, certainly bond market in itself? If so, why are you not surprised? Or was this just an indication that having a deep local asset market is merely a necessary condition rather than just a sufficient one?
I think the key component there is policies that look responsible in the long run or look sustainable in the long run. The reason I'm worried about the dollar is because U.S. fiscal policies look to me to be on a very hard-to-remedy trajectory. And although Japan's domestic financial situation has been a lot more stable than people would have anticipated, given the size of its domestic government debt, I think that is a component of the decision not to put significant chunks of reserves in yen.
I think, we did not see the same determination on the Japanese authorities in terms of accelerating, promoting the use of yen. Yen has been international currency. The question is the relative importance along the different dimensions, as we have seen, for instance, in China today. And I think that may have been partly responsible for that, which is quite important. Secondly, the rate of growth of Japan, has been relatively very slow compared to a country like China, which is growing at 8-9%. And again, the whole effort by China in terms of expanding the trade linkages that I show in the chart, what we have seen in China is been phenomenal. We don't see in other countries. I think we need a combination of factors. And thirdly, I would say part of the loss in the relative importance of the yen was the yen in euro. Without the euro, I would have said the yen would have remained quite an important international currency.
There were some people on the left-hand, the gentleman at the back, and then there were some people on the left-hand side.
Sorry, may I just jump in and just mention one more thing? If you think about what happened to the pound sterling as a reserve currency over the last decade, sterling is the one currency that had its share grow much more rapidly than any other. And the reason is you compare it with the yen, it was a currency where perceived to be very stable domestic financial conditions and a rocking and rolling yield. Whereas you can call the yen yield on JGBs many things, but at that time it did not look as a very attractive yield.
Yes, sir.
Sorry, apologies.
Given that monetary systems change every 40, 50 years historically, and we're coming to the end of that 40, 50 years currently, and Western central banks especially are against using gold as an SDR or anything else. They'd rather, manipulate the price down rather than reprice it and make it more liquid. And given that Europe is the first cracks of the system crashing because due to government and central bank policies, the system got too abused and got too big for the underlying economy. How do you think the next monetary system will shape up? And do you think, due to the income disparity, which is adding to all the problems, social, populist, if you will, uprisings will force more defaults throughout the system, and that will end the monetary system, or will central banks print even more money and we'll head to global Weimar and then probably end up in war or something? Could you comment on that? Thank you.
There were a few. I guess the reason I'm in between, right? Well, if I may respectfully disagree with your comment that, the Euro crisis is like the end of the system or the end of history. I think we have the tendency whenever there is a crisis to proclaim that to the end of history, the end of Anglo-Saxon finance. When you look at it in a broader historical perspective, crises do happen and happen in the past. I'm sure would happen in the future. But we are learning a lot of experience. We are learning a lot. I've been in the development business for over 30 years. If there's been something that I've been delightfully surprised, is the extent to which policymakers undertake major structural reform. The year before, you could have seen politically unfeasible, economically difficult, complex. I remember I worked in India in 1991 when I was from World Bank and was assigned to give the first structural adjustment loan to India. Who could have believed India could have broken out of the Hindu rate of growth and grow about 8-9%? The reforms that undertaken. I think as a result, I'm becoming a little bit more optimistic in my perspective on the future. I do agree that the current sovereign crisis in Europe is a major problem, but it is not a catastrophe, number one. As I said, there's many combination of market failure, institutional failure. Many people, especially this side of the Atlantic, they knew even inside. When you go back the whole constitutional EMU, European Monetary Union, the infrastructure they put together, they were aware of some of these problems. And they were in the process of making reform as time goes on. I think the timing, they were unlucky that this crisis happened in the wrong time. There's no doubt about that. But again, I'm sure there would be some recovery. It might be slow recovery. The euro would remain as a currency. Who knows? There might be changes, some form or others. And the renminbi, as I said, I totally agree with Gabriel that the renminbi use as an official reserve currency today is very much impeded because of the China closed capital account and weaknesses in the financial market. But the good thing is that the authorities are very well aware of that. They're very conscious of that. They know, and whenever I go to China, they talk about the experience of Japan, talk about the UK. How did they do that? There's a tremendous amount of learning by doing going on. There's tremendous amount of ability and willingness on the part of policymakers in the emerging world to undertake reforms. And the fact that even during this latest crisis, they relatively avoided the major deep economic growth. They faced inflation, and they managed it relatively much better than in the past. They're a good sign that we should be a little bit more optimistic. Thank you.
Yeah, and let me just add a little bit to that. Andrew, you had mentioned these bilateral swaps that China was taking, but, in general, this period, which was one of a degree of stress that we haven't seen for a very long time, was also a period of extraordinary cooperation and collaboration across the policy community and within the international monetary system. So at the end of the day, when you think about the types of ties and solutions that have been jointly worked on by the policy community and governments. I don't know that we'll be able to say that we've had a fractured system as opposed to a system that actually is stronger. And there are, fragilities and failures that were recognized in the run-up to the crises. And I think there's a joint effort to work on these and find cooperative solutions. And those types of things strengthen our international system as opposed to weaken it.
I'd like to, if I may.
Mr. Dobbs.
Linda, you've skirted now around the political aspect of the international monetary system. Am I coming through the speaker? Good, thank you. And you talked about cooperation among the international community. And I just wonder where we stand on that issue. It is clear that the central banks, as has always been their role, have been very cooperative, very expertise, of course, and their cooperation is based on understanding how the system works. But it has not been in recent years, and maybe it's been improving, there's not been the same attitude, I think, in the part of governments, i.e. the political entities. The treasuries, less the treasuries than the parliaments, who, in the case of the United States and its embroilment with China, is the most recent example. And Gabriel mentioned the whole question of what the history of the politicians on the question of their exchange and how it has changed over the years. In some cases, and I remember very well in the U.S. policy was a strong dollar, and every Secretary of the Treasury was educated to say that and nothing more, and that was it. Prior to that, secretaries had an inclination to predict where the dollar would be, but soon they learned the lesson on that one. But today, why don't you all give us a view of what the governments, the principal governments of the principal currencies, what their attitude, their policy is toward their currency, and particularly, well, not particularly, all of them. In the case of the euro, it's a question of which government you talk about, but it would be interesting to get your feel of the impact of the politicians on exchange rates and the exchange rate system.
That's a very good question. From the Federal Reserve perspective, of course, the Federal Reserve is committed to, a currency that has a low inflation rate and a relatively stable inflation rate. So to the extent that your goal is to have as strong an underlying economy as is possible, then that is supportive of the use of the dollar in international markets. There is no target exchange rate, as everybody knows. The Treasury does have this strong dollar commitment. If you look at speeches over time on what's been meant by the strong dollar, the most recent, say, decade or so, even 15 years or so of statements about what's meant by that is not the level of the dollar, but again, supporting the international use of the dollar. I can't really speak to what different factions in the government would like. But the dollar, the official view is that this is a market-driven exchange rate, And wherever the market goes, it goes, but you want to have as strong an underlying economy and the best institutions possible.
Thank you. Next. Do you have any comment on this?
Well, I totally agree with Linda. I think we have seen, obviously, much greater degree of cooperation, collaboration, and, joining hands among the central banks. And interesting, obviously, given the high technical areas that they work on, they can understand each other's language much better than the politicians, there's no doubt. And to some extent, I would give some credit to the BIS, Bank of International Settlement. I think it's done a marvelous job in providing the overall umbrella, bringing the central bank together, and providing that, articulating various issues that affect all of them, and bringing about some kind of common position vis-a-vis those. I mean, that's been a great progress. On the political side, obviously, politicians have to respond to different political needs, political pressures, and the degree of collaboration or cooperation, by definition, is going to be much less.
Yes, I'm going to agree with everything that went before. I think politics have an influence on the exchange rate system, or politicians, as a result of crises. I think that's what we have seen after the Second World War, most obviously, right? And in many ways, that's what we are seeing is happening in Europe today. As well, and what also to some extent happened in 2008, 2009, when Treasury secretaries could come together and agree to cooperate in the common good. That's the one aspect, and I think we need big shocks, and we get changes that are somewhat unpredictable, but if you look at everything else the same, I'm not going to sound like an evolutionist, but things have on the whole, it turned out slightly better over time. Once you've said that, and I don't like to comment on regular politicians and statements about the exchange rate, because I don't think that most politicians would know an model of exchange rate determination if it bit them. So I'm not going to go there.
May I thank, first of all of you for coming. And if you are interested in further presentations and an association with us, and you haven't given us your name, I wish you would do so. Secondly, may I, on your behalf, thank our three speakers, who I think have done a wonderful job in a relatively short time to expose to us current issues that are of interest to all of us. And I think we were very, very fortunate to have our three speakers with us today, and I'd ask you to join me in thanking them. And that concludes this session.